Hello, everyone. This video is just a few notes on expenses, and we're just going to touch on a few bullet points regarding that. Then we'll also get into a couple exercises and your Project One portfolio in the next video. For this, we're on page 21 through 29 in your guidebook. Couple things you want to watch out for. With money management and watching your expenses is ask yourself if you're pulling money out of your savings account or you're tapping into credit card debt to make ends meet every month. If you're doing that, you may obviously have a problem. And if you're having to do it every month. Now, the reason I bring that up is there's a video that normally in the in-class, normal personal finance class I show, and it's a Susie Orman video, and there's a lot of bad advice out there, and I have to say, in this situation, and this video I think was created in 2007, she talks about trying to make ends meet and tapping into a credit card, even for normal monthly expenses. I, along with most financial advisors, would tell you that's very bad advice. Whenever you're having to do that and you're employed, that's usually a pretty good indicator that in some way, shape, or form you're living outside of your means. So when you're doing stuff like that, really catch yourself and say, what's wrong here? And later on we'll talk about something else regarding that. All right, a couple of other notes. Oftentimes when times are a little tight and the budget seems to be crunching you, or you don't seem to have enough income, one of the first things most people try to do is cutting variable expenses. And we talked about the difference between fixed and variable expenses. Fixed expenses are typically contractual. They're about the same every month, whereas variable expenses vary. They adjust. They can go up and down, typically from month to month. And one of the things, and there's even an author that talks about this specifically, is cutting out the latte or cutting out the coffee every morning at Starbucks. Now, I'm not saying that's a good habit to be in, but I'm also going to suggest that there might be a little bit better way. And again, when times are getting tough, it's a lot easier to first cut fixed expenses, not variable expenses. Variable expenses, when you try to cut them, often require you to change your lifestyle, and it's less likely that you're going to be able to do that or want to do that. And cutting fixed expenses can often require less of a lifestyle change and just a little bit of legwork. It's not something, in other words, you have to do every day. So when times are tough, variable expenses, again, are usually the ones consumers think to cut first. The problem, again, with cutting variable expenses is it requires you to have a lot more discipline, be it at Starbucks or be it in other places. So we recommend you cut fixed expenses first, and usually that only requires a one-time action. And then for the most part, you're left to live with it. One of the things you could do is reduce your internet speed. I know, I'm along with you. I wouldn't ever do that. But maybe cut the cable. Try a media streaming device instead, which I know some of you probably have, is like a Hulu account or Amazon Prime or Netflix and something like that, where you're spending $7 a month versus $7 or $8 a month versus $70 or $80 a month. Maybe find cheaper car insurance and go shop around for that. If you want to keep your cable, call the cable company and ask, maybe threaten them a little that you're going to leave and go to a cheaper provider, and maybe they'll send you to the retention department and try to give you a good deal for the next year. Other things that you can do, maybe refinance, which is not something I normally would advise doing for the purpose of cutting down your mortgage payment. But if you really need to, maybe you had a demotion at your work and that was the only option, then maybe refinancing would be a better option or a decent option for a time being. So those are all things to look at. Again, you'd be better off if you cut your fixed expenses first and then move to your variable. because the variables, again, usually require a lifetime change. Fixed expenses are those that are typically contractual: rent, mortgage, phone, medical insurance, car payments are all areas you might want to consider, again, trying to negotiate or rework something. Now, one of the things that I like to talk about, and I don't know if any of you are familiar with the personal finance guru Dave Ramsey. He's also a conservative talk radio show host and has a business called Financial Peace University, where he goes around and teaches about personal finance. And I was watching a story one day that I could relate to, and he was talking about himself and his wife. And when they first graduated school, they were able to buy purchases for their home on credit. And he talks about going out and buying these new stereos and furnishing an entire house. And I think I did about the same thing when I got out of the Marine Corps. Now, a little different than Dave Ramsey. I'd saved probably about $15,000, and I took $2,000 of that and went to a number of different stores, went to a furniture store, and furnished the apartment I was going to be moving into. And it was kind of funny because I had my roommate, who also was a former Marine. His mother and my mother came to visit, and they walked in there and thought it was kind of funny that two bachelors had a fully furnished place. And I'll talk in a minute about one of the reasons that I did that. I believe after working 6 years in banking, this is often where young people start living outside of their means. And it's when they start furnishing a house for the first time. And as Dave Ramsey talks in his videos and financial peace courses, says we, for whatever reason, want to have the same house we grew up in. And I can attest I did the same thing. The problem with that, though, is that we're not willing to be patient, and we try to furnish it all in one foul swoop, whereas something like that may have taken our parents 10, 20, 30 years. My parents are in their 70s. Well, I shouldn't say that. My dad is in his 70s. My mom's in her late 60s. And I'm sure it took them 10 or 15, 20 years to furnish their house in the same way I had furnished my apartment in the matter of 1 week. So it's something to think about. Now, I'm not saying don't furnish a house, but it can be very expensive. And it's easy for a person or a couple, if they're married, to get in the idea that they have to recreate that. Now, I remember I was telling you a little bit that when I first got out of the Marines, I had done that and fell into that trap. And I remember my girlfriend, who is now my wife, said couldn't quite understand why it was I had to fully furnish a house like that. And I think the reason I did that is for 4 years I had really lived out of a duffel bag and had no creature comforts. I had basically what was equivalent to a dorm room. Not very often either having a dorm room, but I lived in a Quonset hut. If you've ever seen an old Marine Corps movie, it lived in something like that for 6-8 months, and again, just had no creature comforts. Never had a couch or anything other than, if I was lucky, had a bunk bed, and again, lived out of a pack and a duffel bag and a foot locker. So the only creature comfort, once I finally was in what would be comparable to a small dorm room, that I had was an office chair like this on the screen. So after living like that for how many years, I said, enough's enough. When I get out, I'm going to buy a couch. I'm going to buy a, nice recliner. I'm going to have some creature comforts. And I said that. Now, again, a little bit of the difference between me and maybe other folks doing that, and maybe I'm just trying to rationalize to you and defend myself, but I had saved that money. And again, I had about $15,000, and I had planned for $2,000 of that to be used to buy some of those creature comforts. So again, Dave Ramsey would suggest that we want the same thing that took our parents or grandparents years to accumulate, and we want them right away. All right. The interesting thing with that, I told you my wife at the time couldn't quite understand why I would do that. And I remember when we first moved into our house, We got into a bit of a debate where the house we'd moved into had a driveway that was, I think I measured, was about 2,400 square feet, and it was on a main road in Brookings. Actually, it was on South Main, if any of you know what I'm talking about. And we got this house, and it was the middle of winter. And I remember getting into a discussion or a little bit of a debate with my wife, and I said, well, it looks like we're going to have to get a snowblower. And it was interesting because already we had sort of not seen eye to eye on many of the house purchases. I was actually quite glad I came to our marriage with a number of those creature comforts, because my wife kind of looked at those as maybe extravagant, or not necessarily needs but wants. And even the snowblower, she believed that it was a want, not a need. And we found a number of times that this got into debates, and who am I kidding? They're flat out, some of them are arguments, whether or not these things were wants versus needs. And typically my wife would think it was a want, and I would think it was a need. Now, again, since my wife's not here, I'm going to go ahead and tell a little more of the story. It was funny, the first time we had a snowfall when we moved into that house, my wife got home early that day, and I had to work a little bit late that night. And we decided, okay, we're going to try shoveling it with a couple of shovels we had. We got about 5-6 inches of snow. And she got off work about 3:30 that day and was shoveling, and at 7 o'clock I got home that night, and she was still shoveling and wasn't even probably halfway done with the driveway. And after that, she agreed a snowblower would be a much better option, especially if we both had to get to work early in the morning. So we got to use snowblower, and it worked out well. So anyway, after going through that, I thought, what would be interesting, and especially, again, for young people, I know some of you are not, you might be married and have already experienced this in life, but for those that haven't, one of the exercises I assign in the in-class personal finance cohort is I have all the students in the classroom, usually about 50 students, break up into groups of 2. And then I marry them. Till death do they part, or until the class ends. And we go through, and I hand out a list to them that you're seeing on the screen here of about, 30, 40 different items. And I go through and I have them fill out to say which thinks it's a want versus a need. Now, if they agree, fine, we cross it off. But if they disagree, I have the 2 of them circle it. And by the time they get done, we look at and go through all of these items to see how many arguments they would have. And as I explained to them, very often when it comes to personal finance, that's where lines get drawn into the sand. People, for whatever reason, become less willing to negotiate when money or their money is being spent for items and things that they don't necessarily want. So again, one of the ones that I like to do is the mattress. Virtually everyone in the classroom will agree that a mattress is a necessity or a need. Yet a bed frame, most of them say, or 3/4 of them say, no, that's a want. Pillows, again, most say it's a want, a need. A few say it's a want, and so on and so forth. Another one that I always like to go through is a printer or a computer. In this day and age, I would agree some form of device that can connect to the internet is kind of a must-have. For me, a printer is still a must-have. I think you need that in this day and age. So again, the purpose of this exercise is not really to judge what is a want and a need, but to understand how often arguments can crop up when you're working with somebody else or dealing with a spouse, and one thinks something's a need and the other thinks it's a want. Later on in the section on money and marriage, we'll go through something called a Thompson-Kielman model, which is a conflict resolution model to overcome that. But before we get to that, one of the things you could do, and I have used with my wife, is First, don't create bad habits. One of the things that I've done, and I know others have done, is every time you get a paycheck, going out to the store right away and buying some of these items. Now, in my mind, these things were needs, but looking back, admittedly, some of them I would just purchase because I would think I'd need them. And I found out usually shortly thereafter I didn't need them. One of them was a router. If any of you do woodwork, router's a thing that curves beveled edges like on a table. And I don't know why I got that, but I clearly realize now, since I've only used it twice in 10 years, that that was not an item I needed. But I thought I needed it. So don't start forming bad habits. Start planning instead. If you or a significant loved one, your spouse, are looking to buy these items, and again, one thinks it's a need, the other maybe thinks it's a want, you should always be planning these things. Keep a list. And one of the things that I would highly suggest is do something called a Pareto analysis. And this requires you to tap into your inner geek. And what a Pareto analysis will help you do, it's sometimes called a priority matrix, is take a list like we have here, and you can just download one of these lists online, just a household list of items that you may want, and go through them and prioritize them based on number, and each of you give a score to maybe a higher score for those things you think are needs, and then just go on down the list. Then what you do is you add up to two scores, and whatever has the lowest score is maybe the item that you need to get first, or you could do the opposite, and whatever has the highest score, and you combine them and average them out between the two of you. Now, one of the things you'll want to do is agree this is how you're going to get these items to begin with. Again, one of the things we want to watch out for is creating debates and arguments when they're really not needed, and instead try to use a process like this. Again, would you feel a little weird using a Pareto matrix to do this? Yes, but if it prevents a fight, maybe it's a good thing. All right, few things between theory and application when it comes to expenses. In the theory, household furnishings are often listed as expenses. I don't list them as expenses because I'll often sell old items that I don't want via eBay or through a rummage sale. I'll try to get some money back from them. So I just list them as assets. But if you're the type of person that just throws these things out when you're done using them and you don't try to get any money back for them, then you probably want to list them as just expenses. Again, we talked about living beyond your means. And the other thing that the reason I classify household furnishings as assets is trying to make an attempt to save for those. And usually a savings account is an asset. Even though household furnishings are depreciating assets, if I'm taking money out of my checking account, putting it in my savings account in order to plan to buy household furnishings, that's typically a household asset in my opinion. But again, there's theory, then there's what I do, and then there's somebody that lives down your street and how they figure this out. So it's up to you with household furnishings. Again, the biggest thing we focus on if we want to become wealthy is our net worth. So it doesn't matter how you do it. All right, and then we get into household expenditures. And I'll start with my story now. I'm not going to tell it again when we get to the benchmark exercise that we'll give you. The first money management workshop I ever gave, and I gave it to folks that were in college, did a, I don't even remember, a workshop of some sort through the University of Sioux Falls. But I sat down with the participants in this workshop, and we talked about expenses. And this one gal was a little, I don't know, kind of sarcastic and quick, and she said something to me. She's like, okay, so I get it, Bruce, as long as you spend less than you make, and you budget for this, or you plan for this, and you don't spend 100% of what you're making, and you try to save just a little bit, she said, you'll be wealthy, right? And I looked at her, and my eyes must have just bugged out of my head, and I said, no, that's not how it works. And that doesn't necessarily mean you'll be wealthy. And she kind of had a surprised look on her face because, of course, she thought she knew it all. And I said, no, in fact, even if you did that, that doesn't necessarily mean that you would be considered wealthy. And one of the things I realized is I was assigning this budget exercise to the students, and I basically just said, okay, you make however much, go ahead and start budgeting it out, that they had no concept of what it would be what the average expenditure would be for a house. They had no idea how much the average expenditure would be for a car. They didn't, and why would they? They had nothing to compare it to. Most of them had their parents paying for things, and stuff was intermixed. So what I did is I decided, we're going to do this a little differently, and we have two problems here. One, the students had no way of knowing what they should spend. The other problem that we had was what they were planning for was paying 50% of their income for a car payment. And I was trying to explain to them why that wasn't really a good idea. And I thought, well, how can we solve these problems? Another problem we had was none of them were saving anywhere near enough for their retirement. So I looked at it, and finally an idea popped up one day. I saw this picture in an article. I think it was in a Money magazine, and subsequently got it from the Bureau of Labor and Statistics, I believe. And it was the average household expenses broken down by category in the United States. And this is for 2009. So what I thought was, if we use this calculator and we make it a goal to benchmark to this calculator, and our goal is to, for almost all of these categories, is to actually spend less than the amount that are the U.S. average, and in some cases significantly less than what the U.S. average is, and then we try to increase our savings or our retirement, and I'm trying to find it here and I'm not seeing it, insurance and pension and Social Security. If we try to increase this amount, then again, in theory, you should become wealthy, and that should be the goal. Now, one of the things I want to say here quick is you'll notice Social Security and pension, about 7-point-something% of this is actually just Social Security and what's taken out of your paycheck for that. And what's left is like 2.3% is actually what the average household saves for their pension or their retirement. So it's very important that that number actually be much, much higher. Again, and if you want to become wealthy, just for the pension, that would want to be in the 15 to 20% range. So again, if your goal is to become wealthy, and to be honest with you, when I started learning this information, that was my goal, was to become wealthy. Then if that's the case, we're going to try to share some numbers with you in the benchmark exercise, which is basically a budget, in order to help get that. Again, this is this same diagram, only in table format, and we can see usually the largest expenditure is for housing or a physical dwelling that you live in, like rent and things like that. Pension and Social Security is usually the next highest one, and I want to again say that something like 7+% of this 10% is for Social Security, and you don't have, for the most of you working and employed by an employer, you don't have a choice whether or not to pay Social Security. You're just going to have to pay it. If you're self-employed, it's a little different. And then pension is only 3%, which again is not wise. I talk a little bit about an emergency fund, and this will be a reoccurring theme throughout this section. One of the questions is, what happens if you run short on cash each month? Or what happens if you lose your job? Well, we would want you to have an emergency fund. This will be a test question on both your midterm and your final exam. Most personal financial professionals, that's what PFP is, recommend saving probably between 3 and 12 months worth of average expenses. Okay, not 3 to 12 months of monthly income. There's a reason why we look at expenses and why it is so important that we know it's expenses and not income. Because 3 to 12 months worth of expenses, and it's actually certain expenses, if we save that up and we're saving, say, 10 to 15% for your pension, well, the amount that you have to save, save for an emergency fund actually would decrease. If you have more tangible assets and your other expenses are higher, say your house, your mortgage payment, vehicle payments, and those things are higher, well, then you have to have a higher emergency fund. But if those are lower, then you need less of an emergency fund. Whereas if you did it based on your income alone, you could have a very high income and then you'd have to have a high emergency fund. But that doesn't make any sense because you have an emergency fund to pay for emergencies and expenses. So, all right. Now, another option is using what's called overdraft protection. So if you're running short on cash at the end of the month, the bank would suggest you get this. What overdraft protection is a service offered by banks that allows checking account holders to temporarily make purchases with a debit card, even if they don't have sufficient funds in their account to cover them. In effect, the bank makes a short-term loan. The account holder's debit card isn't declined at Walmart or wherever. In return, though, the bank is going to charge you a very high fee, minimum of $10, and usually it's going to be a lot closer to $35. And that's not until you get paid. That's per item. So if all of a sudden you haven't gotten paid yet and you need to go out and go grocery shopping and you bought $100 at the grocery store and then you went to the gas station and then you went to the bookstore, each one of those transactions would be charged a $35 fee. You can see real quickly that adds up to over $100 just to make sure that you could use these items. So typically, from a personal finance standpoint, I don't want overdraft protection, and I would advise you don't get overdraft protection either. The downside is, and this happened to me one time, I forgot to transfer money into one of those separate checking accounts, and I went to go make a transaction or do a transaction. I actually got declined when I went to the cash register. Some people find that experience very embarrassing. My mother, for example, would freak out if she got declined using a credit card or using a debit card at the grocery store because she just would think it looks bad. Me, I don't care. I have plenty of money, not to be bragging. But if somebody thinks that I'm not able to pay for that, it's not because I'm short of cash. Total, I have plenty of net worth. I don't have to worry about that, and I don't have to worry about what somebody else thinks about me. But I surely don't want to be charged a $35 fee just to save my ego. All right, and in this day and age, Regulation E from the Office of the Comptroller of the Currency, which is a bank regulator, changed this, I think it was 5-10 years ago. And you have an option to either what's called opt-in or opt-out of having overdraft protection. In your bank, when you open a new account, will have you sign something to either opt-in or opt-out of overdraft protection. If you choose to opt-in, nothing. Your card's going to continue to work as it does currently with no interruption in service, but every transaction that goes through without funds being available in your account, you're going to be charged between $10 and $35. Now, if you opt out, just as I said, like I did, and I said, look, go ahead and decline the transaction when I'm at Walmart, I'm fine with that, but don't charge me $35 per transaction. And that's opting out. And again, you'll be declined at those places. But again, you also won't have to worry about being charged a fee and overdrawing your account. All right, some other tips for managing cash flows that I would recommend is don't buy assets with money in your checking account. We talked about doing a checking account system before, or a multiple checking account system, and using those checking accounts for different purposes. Some people say Well, won't your bank be upset if you do that? My wife asked me that one time, and I laughed and I said, I'm a former banker, and let me tell you, when people have multiple checking and savings accounts, usually the bank's happy because those people are far less likely to leave. In most community banks, they don't charge for a free checking account. Now, if you're going to have an interest bearing checking account, which I would not recommend unless you're at the age of 70 years old or more, get a free checking account, or what's kind of classified as a free checking account, where you don't have to pay anything to use it. The reason I say don't buy assets with money in your checking account is because if you start along that process, you start buying assets with money out of an account. And when you segregate and say, look, I want a new couch, I'm going to start saving for it. I'm going to separate it out of my checking account and start saving for it in a savings account. And then you keep a ledger of that. It gets into a very good habit of saving. When you just say, I really want a new couch, and you got $3,000 in your checking account, you don't plan for it, and you just go to the store and buy one, the problem with that is it's creating bad habits. And that's what we want to try to break. So I advise, make a mental note, just take money out of your checking account and start saving for it in a savings account. And the other problem with it is you can't start figuring out maybe why it is you're running short in the month. I use a checking account just to pay for expenses, not assets. And it's very easy to see, and we'll talk about mint.com here in a minute. It's easy to see why it is I would be going over budget. All right, couple notes here. We're going to talk about something called good debt and bad debt. And there is a ton of bad advice out there concerning this topic. The old age wisdom, which hasn't changed from 50 to 100 years ago, is there is such thing as good debt and bad debt. If you notice, I've put on the D2L poster a discussion question, and one of the things I list on there is all good debt, or is all debt bad debt. And there's a lot of people out there that would have you think that. The answer to that, though, and this is from a former graduate adjunct professor of finance, is no, not all debt is bad. Bad debt is often what's called consumer or personal debt, and that's debt usually used to depreciate or purchase depreciating assets or fixed or variable expenses. If you're using debt to purchase those items, that would be a very bad use of debt. But there is something that's called good debt, and that's usually called investment debt, or we also call it leverage, and it's debt used to purchase appreciating assets and more of business investments. Those are good uses of debt, and later on we'll get into a principle called economic value added. Sometimes it's called net residual approach, and in those cases it can often be very beneficial because you're playing a money game where you're trying to borrow money to pay for items that typically there isn't a lot of risk to them, if that's possible. And then you take any money you have that's called equity, and we take that equity and invest it in one place, and then we borrow money from a bank and invest it into a business investment. Think like family farming or small business loan. And we are getting returns from two sources. So again, that's called good debt or business debt. The reason I say be careful searching the internet about this topic is you can get a lot of goofy advice out there. Dave Ramsey would tell you that all debt's bad. Well, I, along with most corporations in the United States, would say, no, that's not true. We're also going to watch some videos that I think will intrigue you regarding the use of debt, just to make you think a little differently. But again, most personal debt or consumer debt is bad. The only debt in the perfect world that you would ever maybe want is for a mortgage or a house. And the reason is because that appreciates at about the same rate as what you're paying out in interest on a loan to buy that. So it's net neutral, and at least isn't bad debt. So something to consider. this is a list of appreciating assets. I always have somebody ask me that. Investment assets, business opportunities, real estate, sometimes collectibles, but if you're going to get collectibles, you need to have a lot of experience and you're using it as an investment. And education can sometimes be considered an appreciating asset. I shouldn't say it's an appreciating asset. It has a rate of return that can be tied to it. So something to think about. Whoops. List of depreciating assets. We have vehicles, household furnishings, clothes that can be resold, computers, phones. And one of the things I do is I ask students in class, how can you make money off all 5 of these things? And we talk about just getting out of your mindset of thinking that these are expenses and other things, and sort of as an academic exercise, how could you generate revenue off this? One of them was to do the, I think it's called Uber with vehicles, and basically like you're a cab. And household furnishings, one person said rent it out to places that are trying to have parties or a house party. All right, we're going to go ahead and skip this. Talk a little bit about that. And one of the other things that's happening in this day and age, unfortunately, that I want you to be aware of is something called the consumer hourglass theory. And a number of years ago, Citibank investments arm noted that investors should focus on companies that sell well to the highest income earners and those to the lowest. And what they were trying to say or suggest is that we're going to have a shrinking middle class. And it's been eroding away now for a number of years. To some respect, their investment theory has worked, and their index of stocks for the theory has outperformed the market considerably since its inception. In other words, that is happening. We have a shrinking middle class. That's not good for many of us in this class. It's not good for me. But I think the point to understand here is how often this can be tied to a mindset. And one of the things that I want everybody to think about is, where would you rather be? Would you rather be in the lower class or the upper class? And if that's something you're interested in, often that requires changing your mindset. Before I told you about these items and how would you make money off that, and that's really a wealthy person's mindset. Book that I highly recommend reading is called How Rich People Think by Steve Seibold. And the book is 100 different ways wealthy people think differently than the middle class. And I love this one, number 17 in his book. Average people focus on savings. Rich people focus on earning. And I think it's very important to understand that a lot of people think consumer or personal finance is about cutting coupons and just living frugal and trying to save money. But if you really dive into what it is most wealthy people do, you'll find that many of them don't cut coupons. Many of them don't try to live very cheaply. Instead, they focus on how can they continue to earn more money. Because the reality is, saving money is only a function of how much you're earning. Whereas earnings, we would assume, is unlimited. Your income can be unlimited. Now, I would agree with most that say, well, that's not totally true. Or in reality, that isn't exactly going to happen. But it is true that you can work at ways to increase your income. And one of the exercises or discussion posts was looking at ways you can earn money other than just the money you're going to earn from your career. And again, in this day and age, I would strongly consider some of you look at those options as a way to generate more earnings as opposed to just focus on saving. They often, consumers can often get wrapped around the axle and focus too much on cutting expenses and trying to save as opposed to look at how maybe they can earn more money. One of the other thing that wealthy people try not to do is to nickel and dime themselves to the point where they're actually losing money. I talked earlier about the leaves situation and how trying to save money can actually cost you money. And don't do that. That's something called opportunity cost. All right, that's it for this video, and we'll see you next time.